Retirement Savings Plan Basics, or RRSPs. We put together this particular presentation for folks that maybe for the first time they're looking at making an RRSP contribution, and they just want to have a basic overview on how these accounts will work, how they work, what they're intended for, and how they play a role in your overall financial planning. Another group could be those of you that have been making RRSP contributions for many years, but you may not be all that clear on the mechanics, and you just want to get up to speed again on why am I making this RRSP contribution, how does it play a role in my overall financial plan. And then the third group would be a group of people that you may be a parent or you have a young adult in your life who you think needs to have a better understanding of saving strategies, and that RRSP planning might be one strategy that they should be aware of. And so it's a good just magic moment or educational moment for that young adult to get them thinking about why this is an important area. Particularly with RRSP planning, the earlier you start, the more powerful it can be over time. We'll have some examples on that. Now, this presentation will not be talking about how to compare different kinds of options, whether it's tax-free savings accounts or RRSP plans or pension plans, and how to figure all that out. That's going to be a future video that we're going to put together. So we're just going to talk specifically about if you're about to make an RRSP contribution or considering it, this is how it works. These are the basic mechanics for the plans. So first of all, let's talk about the retirement income planning pyramid that I put together here. At the bottom of the pyramid, the base, you have old age security and Canada pension plan. So the basic level of government benefits. They're really not intended to be the majority of your retirement income, but they're a base to supplement your retirement. The next rung for many Canadians, they'll have employer-sponsored pension plans. The two main kinds would be defined benefit pension plans or formula, and defined contribution pension plans. And then on top of that, there'll be RRSP or tax-free savings accounts. Now, for self-employed individuals, many times if they don't have individual pension plan, the RRSP plan might be the primary building block for the retirement income. So you've got RRSP planning for those individuals, or it might be a top-up or supplement for people that have employer pension plans. Once an individual is maximized on all the opportunities up to the RRSP tax-free savings account area, then you have open accounts, and so that's investing outside of your RRSP into non-registered accounts and looking for investment opportunities there. Again, it likely implies a broadly diversified strategy as part of your retirement income planning. And then the last area would be specialty assets. And an example of that would be things like maybe collectibles, might be art. You know, I know of individuals who invest in their art. Their art hangs on their walls, and they get both the enjoyment of seeing the art, but it also has value. So that would be an example of a specialty asset. So we're going to talk about the RRSP planning area today. So who should have an RRSP? Well, again, there's a lot of different reasons why you'd want to have it. You do want to look at the RRSP in the context of other accounts and your own particular circumstances. But the first reason would be you want to reduce tax. So the RRSP contribution does reduce the tax on your tax return. Secondly, it could be an important supplement to your employer pension plan. I'll talk at the end of the presentation the importance of developing your own personal retirement plan, and you'll see there when you walk through that kind of analysis how the RRSP might be an important supplement to what you're doing at work. Income splitting. You could have a situation where the husband or wife have a pension plan but their partner does not have one, and making what's called a spousal RRSP contribution, or encouraging that partner to make a contribution to the RRSP, can over time help to equalize the amount of retirement assets you have in your names when you reach retirement together. When you have that equalization, it's just one of those strategies you can use to equalize and reduce the tax burden through your retirement years. For first-time home buyers, RRSP money can be tapped into to buy that first home, so you get the benefit of a tax deduction, so tax reduction, tax deferred compounding, and then you can tap into that capital to buy your first home. And you can take advantage of fluctuating income. Now, this may not be a primary reason that people would make an RRSP contribution, but you can have situations where, let's say, someone deducts their RRSP contribution at the middle tax rate, let's say 40%, and then down the road they have reduction of income. You might be on commission sales, could be a maternity leave or paternity leave, could be different reasons why that would happen, maybe going back to school, and now you're at the lowest tax bracket. So that might create an opportunity to pull money out at a 25% rate when you made the contribution was at a 40% rate. So there's actually a tax win between those two numbers. Now, over the long term, that may not be a great approach because this money really is for retirement, but there may be times that you can take advantage of fluctuating income and use the RRSP to take advantage of that. So what is an RRSP? What are the basic mechanics around it? First of all, contributions are tax deductible. So when you put money into the account, you get a tax deduction. Investment earnings grow tax deferred. In other words, as you're compounding money within the account, if you make 5%, all 5% gets reinvested, as opposed to many non-registered investments. If you get a yield of 5%, you're going to pay tax on that yield. Let's say you pay 2% of it goes to tax, you're left with 3%, so you get less money internally compounding. So that's one of the big benefits long-term of an RRSP account. And it's intended to provide retirement income. That really what is an RRSP is for, is to supplement your old age security, CPP benefits, and maybe company pension plans. So look at RRSP regulations. On the right-hand side, I'm showing you the contribution maximums. So in 2012, it was $22,970, and for 2013, it's going to be $23,820. And ongoing, the contribution rates will just be indexed to the average increase in wages across the country. So those are the maximum levels that we're dealing with. The limit is the lower of 18% of your earned income from the previous year, or the maximum annual contribution limit for the taxation year. So you've got those maximum limits on the right side of the screen. That maximum will be reduced to the extent that you have an employer-sponsored pension plan. When you make contributions, you'll be issued on your tax slips what's called a pension adjustment number. That really is the value of contributions that went into the pension plan, your contributions, employer contributions, and you need to deduct from your maximum level that pension adjustment figure to come up with a net contribution that you can make to your RRSP for the year. Other regulations to be aware of: earned income includes salaries and wages, alimony received, net rental income. It could also be things like being an executor. Executor fees actually qualify. Things like interest income, capital gains income, dividend income, which is referred to as passive income, does not qualify. If you're a member of an employer-sponsored pension plan, the amount that you can contribute to your RRSP must be reduced by the pension credits. We talked about that in the previous slide. That's your pension adjustment number. The pension credit is referred to the pension adjustment, like I said, and it's reported on your T4 that's issued by your employer. RRSP deadline, basically you're eligible to make deductions in a specific taxation year through the year, but you also have up to 60 days into the following year to make that contribution. Carry forwards: if you can't make your RRSP contribution for the year, or maybe just a portion, the unused amount can be carried forward into previous years and the next years indefinitely. So you have this carry forward room that if for whatever reason you don't have the money or the cash flow to make the contribution, you can always make up for it at a later time. And you can choose to delay claiming your current year's RRSP contribution. So why would you do that? Well, you could be in a situation where you have RRSP room, but you think that maybe your taxable income might be higher down the road. So in that situation, if I'm at the lowest tax bracket but have room, I might take the money, put it into the RRSP. So now it's growing on a tax deferred basis. But I may defer claiming that deduction to a following year. If I think I'm going to go up to the middle tax bracket from 25% rate of tax to, let's say, 40%, it would make more sense for me to claim it in a year when I have a higher tax rate than doing it this year. So those are two very powerful things: the carry forward provision and the ability to delay claiming a deduction if you think you might be at a higher income bracket down the road. Over contributing, you are allowed a little bit of buffer. So to the extent that you make over contributions above your allowable limits, up to $2,000, there are no penalties. Above $2,000, there's a 1% per month penalty tax, so it's important you not go over your allowable limit. You can also have as many accounts as you wish. So you could have RRSP accounts at many different institutions, and if I could make $10,000 contribution, I could make, I have 5 accounts and put $2,000 in each of those accounts. So it's almost unlimited flexibility from that standpoint. And you can transfer money from one RRSP account to another on a tax deferred basis. So if I have money in one institution, I decide to consolidate to another institution, you can transfer that money without triggering any tax to the institution you want to move the money to. So let's kind of look at the RRSP in action. So in the middle column, I've got 0 RRSP contributions. So my taxable income is $30,000. My combined federal and provincial tax bill is $7,800. and I haven't deferred any tax in this situation because I haven't made an RSP contribution. In the last column, I've made a $3,000 RSP contribution, so again my taxable income is $30,000. My tax bill is dropped by almost $800, so I've been able to defer tax of $780 for that year by making an RSP contribution of $3,000. So in a nutshell, that really is what one of the main benefits of an RSP plan is. Let's look at another example. I have earned income of $60,000, so my limit is 18% of the $60,000 is $10,800. I'm a member of a pension plan at work, and my pension adjustment number, or PA, is 6,000. And so my limit is $10,800 minus the $6,000 pension adjustment number for RSP contribution limit of $4,800. I've carry forward of 2,000, so from previous years I've got a little bit of unused room. And so my RSP room for this year in total is the $4,800 RSP contribution for this year, plus my $2,000 carry forward, which gives me an allowable room of $6,800 for the taxation year. Now let's look at the RSP versus non-RSP compounding. I'm going to use 4.5% return, 10 years will be the period, $5,000 per year saved, and my marginal tax rate, basically at the lowest tax rate, is 25%. So in this example, what you can see is that over that time frame, if I had invested outside the RSP, the growth would have been $60,288. Within the RSP plan, it's $64,206. And if I had actually reinvested the tax refund, that would have been another $15,000 of capital. So you can see that just even over that 10-year period, there's a net advantage to the RSP contributions. In this example, again, 20-year time period, lowest tax bracket, and so my non-registered plan that's earning taxable growth is $144,000, tax refund reinvested $36,000, registered retirement plan is $163,000. So I'm over $200,000 in value in that particular example. In this example, I'm bumping up a tax bracket, so we're going to 35% marginal tax rate, or roughly middle bracket. So again, over that 20 years, $137,000 roughly in non-registered money, $163,916 in the registered plan, and $48,000 is the value of the tax refund reinvested. So again, over that time period, significant net advantage to the RSP account. And over 30 years, you can see the values here. Non-registered plan, $241,882. The registered plan, $318,762. If I took the tax refund and reinvested, that would add another $84,000 to the calculations. So we've talked about the value of the compound, and definitely when you look at those numbers, the longer the time period, the more the net value. And where it really works well is if I can deduct at 35 or 40%, but down the road pull the money out at 25% tax rates, that powerful delta between what I was able to deduct at from a tax standpoint and pull it out is a great net benefit. And what I typically find for many clients these days, because of the income splitting opportunities between husband and wife or partners, is that most people are at the lowest tax bracket. So the RSP definitely was a win for them. As they were deducting at the middle rate and pulling out at the lowest rate, there was a win. Now when it comes to RSP investing, you've got a lot of flexibility. What I would say to you on this area is that you really want to sit down, work on your retirement plan, determine what your goals are, and that will tend to drive the required return that you need to get on your RSP accounts to fund your retirement. Once that analysis is done, then you can look at the various investment options that you have. It could be individual stocks, it could be guaranteed investment certificates or GICs, a range of mutual fund products could be available, government bonds, provincial bonds, corporate bonds, it could be exchange traded funds or ETFs. I mean, there's many different options, and so you can then craft the appropriate mix of investments for your particular circumstances once you've done that homework on your plan. As your account grows, often it makes sense for clients to deal with full service brokers or brokerage accounts. That allows you a lot more flexibility, so within that one account you can shop or broker or get recommendations for the best investment solutions for your particular circumstances. Redemptions, so when it comes to eventually pulling money out of the RSP account, there are some statutory minimums that the government mandates. so that if I simply just do a redemption from the RSP up to including $5,000, the tax rate is 10%. Between roughly $5,000 and $15,000, the tax rate is 20%. And if it's more than $15,000 redemption, it's 30%. Now the exception to that rule is down the road to get money out of the RSP account, rather than making an RSP redemption, if you have a registered retirement income plan set up, there's something called a RIF minimum, and those RIF minimums, there's no requirement for withholding tax. Now ultimately there may be tax due on that income, but on the RIF minimum you don't have to have the required withholding tax. But this gives you a basic idea. If you simply make just a straight redemption from the RSP, here's the withholding tax amounts. The final tax bill ultimately is going to be driven by all your sources of income. So you could have someone who pulls the money out, it's a 10% tax amount, but their average tax rate might be 15%, so there might be another 5% tax due on that redemption. Retirement income from your RSP, so how do you produce that? I just talked about redemptions, but in your 71st year, that's the longest time period you can defer doing something with your RSP. So in your 71st year, by December 31st, all RRSP accounts must be moved into what's called a RIF, or a registered retirement income fund. Now you don't have to take income in the 71st year, you can actually defer that part until your 72nd year. So the first payment comes out in your 72nd year, and I've just given you some examples of the percentages. So in this interest rate environment that we're in right now, many very conservative investments earning 3% just aren't growing enough to keep up with the required percentage that comes out. So that goose that lays the golden egg declines more quickly for some people than they would like. And the only way of really holding value is to diversify your portfolio out of just all fixed income investments to something that might provide the potential for improved yield, so that your portfolio doesn't go through too much pressure in the first few years. Inevitably, we have to talk about issues around these accounts in the event of separation or divorce. So you can split the RSP assets on a tax-deferred basis, so between the partners, so there's no tax. You can move the assets based on whatever the separation or divorce agreement is. You need to be living apart, and you need to have a formal separation agreement or court order to take advantage of this tax-deferred transfer between the accounts, between the partners. On death of a plan holder, the basic rules are: on death, the proceeds of the RSP account can be distributed to whoever was named as a beneficiary or to your estate. So in a husband and wife situation, or if you have a partner, it really is a deferral of tax. All my RSP monies will go to my spouse. Generally there's a listed beneficiary. That's important because it makes sure that the investments don't go to the estate, so it passes free of the estate and goes directly to the listed beneficiary. And the tax can be deferred. Now, if I'm lost to die in the situation, so my partner or spouse has died, now I have an RSP account or a RIF account, and I die, if I have a listed beneficiary, the money can go directly to those beneficiaries past the estate. It doesn't have to go to the estate, but tax will be due at that point. And so a beneficiary designation doesn't eliminate the tax burden, it just makes for more efficient distribution of the assets to the beneficiaries. That tax is still due. Now, there might be some exceptions to that, so proceeds can remain tax sheltered, like I said, if there's a surviving spouse as a beneficiary. But if there's children or grandchildren who are minors and financially dependent, there's some regulations that allow you to buy a term annuity that can reduce that tax hit for those dependent minors. As well, if there are children who are financially dependent due to physical or mental infirmity, there are again some ways that you can further defer the tax burden in those particular circumstances. Now, those aren't all that common, but the tax rules do allow for some deferral of tax in those particular circumstances. Again, just to summarize, the overriding situation is you've got a partner, all tax can be deferred to that partner, and that partner can continue using the RSP capital to supplement income, can move the money to a RIF to produce regular income. Upon their death, though, in that last to die situation, generally that's now a taxable event. Money can go directly to the beneficiaries or it can go to the estate, but in either situation there'll be tax due on that capital. Now, we talked a lot about the basics of the plan, retirement savings plans, RRSPs. It's really critical that people look at their RSP planning in the context of an overall retirement plan. I'm talking about in this slide game plan. We have a planning program that allows us to do very sophisticated modeling in the retirement income planning area. We look at your investments, your estate, legacy planning, tax reduction strategies in retirement. And game plan basically pulls all those pieces together to help clarify what kind of returns you need to get to reach your goals, how much money you should be saving, what is a sustainable long-term income that would be doable in your particular planning. And if you're not happy with the outcome, you can proactively plan. What do I need to change in my planning to hit the goals that are important? Game plan basically starts with an introductory process where I talk to prospective clients about, what are your goals, what's the process, how can we help you, and in that first meeting you would determine whether you want to go through that process. The discovery process is really gathering information on your particular situation. I really treat client situations like a business owner would treat their business. We provide financial statements, future modeling, and we come up with ideas about how we can improve your current planning. We then deliver recommendations, and finally an action plan. That really is the game plan process intended to give you real peace of mind and clarity around your retirement income planning, and if you're not on track, specific action steps to help you get back on track for your planning. Well, it's my hope that you found this presentation helpful. If you want more information about game plan and retirement income planning and RRSP contributions, don't hesitate to visit my website at www.shaunhumphries.com or zip us an email. We'll be happy to get back to you. And our phone number is area code 204-977-8049. And hope you enjoyed the presentation. All the best with your retirement income planning and your RRSP contribution.